guys, welcome to this episode of Context is King. I'm Rebecca Brayton, and with me as always is WatchMojo founder and CEO Ashkan Karbatrushan to discuss high-profile money-losing ventures of companies that you've heard of, such as Uber, WeWork, and Peloton.
Such as the Iraq. Yeah, those are three very high-profile money-losing ventures.
Are profits actually important anymore then?
You know, that's a great question. I think the original entrepreneurs, the greatest ones early on, really kind of did a lot by themselves. Had to find clients, had to create value, had to generate revenue, and had to stay in the black. There's always like a little bit of like asterisks, right? Like William Randolph Hearst was given a $10 million loan by his mom. The San Francisco Examiner, which his dad won in a gambling debt payoff.
Rich guys and their gambling.
There you go. Here, just take this newspaper. And then he gave it to his son. The senator gave a paper to his son, and then, to his credit, William Randolph Hearst built an empire. Rupert Murdoch, you know, great entrepreneur, but his dad gave him a bunch of regional papers, and he built an empire. Cy Newhouse, same thing. You know, his dad gave him. So these media.
Are you circling Donald Trump on purpose, or?
No. But so the point I want to get to is, you know, who are these self-made people, right? There's always a story. I kind of say, well, I was given a good upbringing and an education by my parents. Am I self-made? You know, we had this conversation when there was not Kim Kardashian's sister. Kylie. She was put on the self-made list of billionaires, and it's kind of like, well, you could argue she is, but you can also argue she's not, right? So it's kind of like, where do you draw the line? But the point I want to get to is, still historically, builders of companies had to operate in the black. What we've seen now is, for the last 40 years, really the rise of venture capital and private equity, where, you know, these people who manage a lot of money that they get from limited partners, including, you know, endowments of the Harvards and you know, pension funds, they come and they go, here's all this money, give us more money over time. And one of those ways is by investing in private companies. So the earliest were still like the Apples and the Suns and eventually the Googles. But admittedly, who were very profitable and created things that were tangible and really like shaped industry and economies. I think what you've seen in the last decade is more, you know, Uber, radically disruptive. WeWork, we don't need to be the latest to shit on the model. It's a crappy model. Peloton, I don't really know if long-term it's going to be around or not. I know the consumers are fanatical about it. The CEO said last year they were weirdly profitable, but when they filed to go public, it was disclosed that they were never profitable, really. So, but the point is, I think what you're seeing is cheap capital, low interest rates, flush with capital from these endowments that have more money than they know what to do, that is being thrown at these privately held companies where the investors know that there is either an IPO, an initial public offering, that you historically have to be profitable, or more likely, the greater fool theory where if not Google, Microsoft, Apple, Facebook, somebody's going to come and write you a big check and acquire you. And when these companies acquire you, they're not actually acquiring you because you're profitable.
Did I see that Peloton is going to file an IPO?
They did file to go public. Yeah, I mean, all these companies eventually, you know, investors put in money, they want their money out, so eventually they do have to IPO. And what's funny is they are creating these kind of like conflicts where Uber hired a CEO and he was going to be given 120 million. I forgot what the amount was, but it was something like if the market value was above 120 billion over like a period of time, he would get this like massive payoff, which kind of makes sense. It aligns you with shareholders, so to speak, but it gives this rush to go public that otherwise may not make sense. Historically, companies go public when they've been profitable for a while. And what you're now seeing is Uber, WeWork, and all these companies not profitable hitting the public markets and investors kind of being underwhelmed.
So, do you think they will do well on the market?
Uber has not. I think Uber will always be underwhelming, and I think WeWork will be a total flop. And I'm not the first to say there's nothing new in what I'm saying. And I think who is left holding the bag are unassuming public shareholders who will buy this.
Because they've heard of it.
Because they've heard of it, even though the people who are going to make money are like the very first investors. And then I think it affects morale because these companies, when they're venture backed, they do go out and give these option grants to employees, but at very high stock prices. And one of the reasons you've seen an exodus of talent is not because they're like, oh, we don't like the culture, or because this executive is dishonest. It's because their options are underwater and worthless. So it creates this bigger kind of vicious cycle.
Right. Well, what do you guys think? Would you buy an Uber stock? Let us know in the comments, and we'll see you next time.